Okay. Hello all, and welcome to our webinar on fundraising in Web3, where we'll specifically be focusing on SAFTs, or what's known as simple agreements for future tokens. Okay, I think we have everyone on. We'll just do some introductions to kick us off. My name is Chris Elias. I am the practice leader in LegalVision's Web3 and FinTech practice. Today, I'm joined by my colleague, Robert Chen, who's a fellow senior lawyer and Web3 enthusiast. I guess, before we kick off, we'd like to start with an acknowledgement of country. LegalVision acknowledges and pays respect to the past, present, and emerging traditional custodians and elders of this nation. In particular, the Gadigal people of the Eora Nation, whose land LegalVision's headquarters is situated on, and the various lands on which those of you are joining us today. Okay, before we begin, a couple of quick points. We will email you a copy of this webinar recording, so don't stress about taking too many notes. You'll get this, so you can have it on file. Feel free to drop some questions in the chat box because we'll do our best to answer them all toward the end of the presentation. And then please complete our survey after the webinar so you can tell us how we can do better for next time. Okay, so as a high level, today we'll be discussing some interesting topics. First is the fundraising in Web3 generally. The second topic, which will be covered by Bobby, the anatomy of a SAFT. Finally, we're going to wrap things up with some key things to consider when fundraising, and that should wrap up the formal presentation, the section of this webinar. We'll have some time for Q&A toward the end, and we have a special offer for you toward the end. It'll be a surprise, so you have to stay tuned toward the end to figure out what that is. All right, so let's get started. All right, so the first topic, fundraising in Web3. So Web3 has introduced some very interesting and potentially game-changing ways for projects to raise funds. To get a full context, we'll look at some previous fundraising methods which will shed some light on where we're at today. So let's start with cap raising and the use of SAFTs. So before Web3, most startups would raise money the conventional way, through the issuing of shares or agreeing to acquire shares at some point in the future. In late 2013, famous startup accelerator Y Combinator released their standard simple agreement for future equity, or SAFE for short, which allowed startups to quickly raise funds without getting tripped up by the regulatory red tape, whilst also still protecting investors' interests. Basically, a SAFE is a simple agreement between the company and investor, where the investor provides the investment amount in exchange to acquire rights in the company at usually a pre-agreed price upon the occurrence of a defined event. And this event is usually the Series A or next round of VC fundraising. SAFEs are still the most common method for early stage startups to raise funds. However, new fundraising methods made possible through Web3 have highlighted how powerful, and in some cases how dangerous, new forms of fundraising can be. Speaking of dangerous, we have ICOs. So in 2017, Web3 projects started doing what was called initial coin offerings, or ICOs, which became known as the ICO summer. It was a wild time. And for those of you who were lucky enough to benefit from this wildness, credit to you. But ICOs are essentially the crypto equivalent of IPOs, except there weren't any disclosure of information obligations. Project participants can remain anonymous for the most part, and oftentimes there were no real middlemen like there are today with the ASX or a publicly listed exchange intermediary. So while there were some interesting projects coming out of ICO summer, so it wasn't all bad, there were also plenty of scams and rug pulls, since ICOs weren't regulated in the same ways that IPOs were. Regulation around IPOs are primarily there to ensure that companies issuing shares to the public release enough accurate and reliable information for investors to make informed investment decisions. And this was not the case for ICOs. And as a result, a lot of people lost money and people took advantage of this sort of gap in the regulations. This demonstrated how harmful ICOs can be to consumers, and ultimately, this drew regulatory attention. Regulators all over the world started to impose rules on ICOs, with some regulators imposing a straight-up ban. Okay, so after the ICO summer came the crypto winter. Market conditions and regulatory uncertainty meant that no one wanted to do ICOs anymore, and many projects were unsure of how to raise funds. Then in late 2017, Protocol Labs, a big player in the Web3 space, Cooley, a US law firm, AngelList, and CoinList started what was called the SAFT project. The project attempted to solve the fundraising issue by creating a standard form document known as the SAFT, which will help projects raise money without breaching regulations, or at least attempt to mitigate the risk of breaching regulations. So SAFT, as I mentioned before, stands for Simple Agreement for Future Tokens, and was drafted to mirror the function of SAFTs, which we covered earlier. So basically, a SAFT is a simple agreement between a company and investor, where the investor provides the investment amount in exchange for the right to acquire tokens at usually a pre-agreed price on the occurrence of a defined event. And this defined event is usually the token generation event, which Bobby will explain later. SAFTs have allowed projects to raise funds from accredited investors, if you're targeting US investors, and sophisticated investors, if you're targeting Australian investors. You'll have to be aware of the regulations where investors are based, because this will dictate and determine who you can offer the SAFT to. For the purpose of this presentation, however, we'll just primarily focus on the Australian and US investors and jurisdiction. So because of its simplicity and the increase in Web3 funding in the ecosystem generally, SAFTs are now a common method of fundraising, and you'll see them, as the common form of fundraising for many projects today. It is also not uncommon for Web3 projects to raise funds through a SAFT and a SAFE, but I guess this will depend on your fundraising strategy and general business structure. So I'll hand it over to Bobby now to take you through the details of a common SAFT.
Thanks, Chris. And so, like Chris said, SAFTs are really commonly used now in the Web3 ecosystem. And at the end of the day, a SAFT agreement is a contract, and a contract's all about risk allocation. So you do want to ensure that your SAFT agreement is properly drafted and has been reviewed by a crypto or Web3 lawyer in this space to meet your project's needs. So we'll begin with a section called the notice to resident, which Chris touched upon earlier. And we'll start with this because this is something that's usually included at the forefront of the SAFT agreement. And it basically notifies the holder of the SAFT as to the relevant and important information that the holder needs to know about that jurisdiction. And so it's directed at investors or purchasers of the rights to the tokens. And it basically ensures that the people reading the notice are accredited investors in the States and sophisticated investors, the Australian equivalent. The US investors, just for a bit of detail, is a type of investor in which they are allowed to purchase or be offered to purchase unregistered securities under US federal law, and this operates as an exemption. And typically you're looking at people or natural persons with individual net worth which exceeds $1 million, or people with individual income with more than $200,000 in each of the 2 most recent years. The equivalent being the sophisticated investors class in the Australian context. Basically, you do have to get a certificate from your accountant which certifies your prescribed net asset or gross income level. And to be eligible for that certificate, you must have a gross income of $250,000 or more per year in each of the previous 2 years, or net assets of at least $2.5 million. Now, moving to the next big ticket item, which is the purchase amount. Now, we're looking at what is the amount which the investor is purchasing in exchange for the right to receive tokens to be issued in the future under the SAFT agreement. Obviously, this is really important. It is the purchase amount. The details can be set out in a table in the SAFT document, which is usually a bit easier to read. That table will include information including how many tokens are being purchased, what's the price of the tokens. And this is usually, like Chris said, this is usually negotiated, agreed upon between investors and the project. And you may use an exchange to calculate this token price. So for example, such as coinmarketcap.com. Being a price that's being negotiated, particularly with early stage participants or investors, you may also want to include a discounted price. And if so, you want to set this out. What is the discount rate? And in doing so and offering these direct token pre-sales, you're able to then finance the launch of your network or the token generation event that Chris mentioned. Moving then to the procedure for the purchase of these rights. So procedure for the valuation of purchase amount. Obviously, this is quite important as well because it sets out how the purchase will be made. You might see a SAFT that makes reference to a variable, which is sometimes the applicable exchange rate. And that's sometimes pegged to what's known as the volume average weighted daily price of the currency. And you can find this again on an exchange. But you do have to flesh out this section. So as I said, you do have to set out the what, the how. And for example, if it's a fiat to crypto transaction, will it be made via bank transfer? What's the bank account? What's the payment method? What if it's a crypto to crypto? Is it a transfer of ETH? Who's covering what costs? So on. So, for example, this clause may look something. It should usually cover off. The purchase amount is valued at the applicable exchange rate, which is the volume average weighted daily price of the currency, ETH or US dollars, on an exchange or index on the day in which the company accepted the purchaser's offer to purchase the rights under the SAFT. So it covers off on all components. Moving next to token use restrictions. So obviously when one purchases the rights to these tokens, they can't do much with the tokens until the tokens actually vest in them in the SAFT holders in a similar way to the way SAFEs work. So typically, your SAFT holder can't sell, transfer, spend, exchange, or otherwise deal with tokens until vested. And that time frame is usually set out in the next component, which is the vesting period for the tokens. And like Chris said, it's very much similar to a vesting schedule, or similar to that of in SAFTs, sorry. So similar to that of shares in a company. And it's quite important for investors to know that for this time frame, there will be restrictions on what they can do with the tokens. And sometimes this may be governed by a smart contract. In some cases, it may be done manually, but it's important that this section, this component is well defined and accurately defined as well, because it may affect your tokenomics and token price in early stages. Moving next to events, your key events to include in the SAFT are either a network launch or a token generation event, as well as a dissolution event, and obviously termination. The most important one is probably in our view, it's the token generation event, because it's the event which effectively, as the name suggests, generates or issues the tokens, and it needs to be specified and defined. So it either needs to be clearly set out to be a specific date, which is not as common, or a platform launch or a listing on an exchange, for example. And obviously that's the event in which the SAFT holder will receive or be issued the tokens. A dissolution event is when the company is wound up or placed into liquidation and obviously can't meet its obligations as a result, and then that will result in a mechanism where there's some sort of refund of the purchase amount. Obviously, finally, there's also termination of the SAFT. And so you do need to, I guess, for the parties to have a way to exit this agreement. So this could be upon delivery of tokens to the holder of the SAFT, upon a dissolution event in which there's, like I mentioned, there's a payment to the purchaser or setting aside of payment for the purchaser. You'd also typically see a deadline date, which is usually some date in the future in which it's a hard date, also known as a long stop date you might see. And this is when the agreement will just wrap up and obviously trigger its mechanisms to make good on the purchase amount, or a failure by the company, and that's the last one to raise sufficient funds. Obviously, if that can't be done, then purchase amount is returned. Moving to the next component, representations. Quite important because of the nature of the SAFT agreement, you are entering into an agreement for something in the future. And it's an exchange of currency or funds for basically a promise for something in the future. So you do want to get the representations right, and you want to get them right on both sides of the fence. And starting with the company, well, some of the key ones you might want to consider are, the company is, registered in a particular jurisdiction. So this might be the BVI or the Cayman Islands or Gibraltar. And the company has the power to carry on business in that jurisdiction. You also want to consider something like a clause that says that the SAFT is a legal and binding obligation on the company. And also that the company makes no warranty in relation to the tokens. And that is quite a broad no warranty representation, because it extends usually to fitness for a particular purpose of title or any infringement of third-party IP rights. On the other side of the fence, the purchaser also needs to be making certain representations to the company. So the purchaser has the power, the legal capacity, and authority to enter into the SAFT. This is obviously facilitated or in conjunction with the nose to resident. So you're already targeting a specific type of investor, but you still want to be making sure that you want to be including these types of representations. You also want to be including like an acknowledgement that the purchaser has been notified of the legal status of the SAFT, i.e., is it a registered security under securities law? And importantly, that the purchaser is entering into this contractual arrangement with the predominant expectation that this project will generate a profit, which is contingent on the successful token generation event or network launch. And you want to also set out that this particular event will also require the company and its employees to do the work behind the scenes, market, develop, and then launch the token or network. Finally, you may want to include, make reference to restricted territories. So you may want the purchaser to warrant or represent that they're not from a restricted territory. And these are typically countries with higher risk exposure. So for example, Russia, China, North Korea, you get the picture. There's no contract really without liability clauses, and you do have to include them, and you do need to have a lawyer look over them because they're quite complex and they're quite critical really to, any sort of contract. But consider the use of indemnities. So for example, will the purchaser be indemnifying the company for a breach of the SAFT agreement? Typically this is usually quite a wide indemnity. And so if you're on the purchaser's end, you do want to have a lawyer look that over to make sure you're not over promising. It also typically sets out purchaser responsibilities, such as security over the wallet which the purchaser will receive and hold the tokens, and obviously consider including a limitation of liability or a liability cap. What else is quite common as well is an exclusion of consequential loss. So reach out if you do have any questions about that. And then finally, with some of the more miscellaneous provisions, but still quite important to have in a SAFT, you may want to make note or specify that this SAFT is one of a series of SAFTs. We also want to include a governing law and jurisdiction clause, because obviously this is quite important as to how the SAFT in the event that there is a dispute and you are in court, that you'll know which law is the governing law and how the contract will be interpreted. And then flowing from that, you do want to consider having a dispute resolution clause. And given the borderless nature of Web3 transactions, an international arbitration clause is not uncommon. And so that wraps up my section on an anatomy of SAFT agreements. I'll pass it back to Chris to discuss key things to consider.
Yeah, thanks for that, Bobby. And yeah, as Bobby mentioned, I mean, he went through the details of a SAFT in quite a bit of detail. Now, it's important to note SAFTs may come in different forms. Some can be fairly simple and short form, which is sort of more aligned to the original intent of the SAFT. But as it is the case with most legal documents, lawyers get involved and they start adding further clauses and further protections and potentially overcomplicating it. But so they can come in long or short forms. But it's important to note that the SAFT should be drafted depending on your circumstances. Again, there might be exceptional circumstances, and sometimes it would require a little bit more thought as opposed to using a standard off-the-shelf SAFT. But anyway, I think that's just one general point to consider. Another one, from a more regulatory perspective, is SAFTs are generally considered to be securities if you're in the US. And in Australia, they are likely to be considered general investment products. So this just means that there are some regulatory issues to consider. But I mean, for the purpose of, a key takeaway here should be, if you are, handing over a SAFT to a potential investor, if they are based in the US, make sure that they are accredited investors, which essentially are high net worth individuals and institutional players. I think Bobby touched on it earlier. And if you're, handing it over to someone in Australia, make sure that they are sophisticated investors, which essentially is just anyone who earns over $250,000 over the past 2-year period, or has net assets worth $2.5 million as well. So, these are just things to be considered. This will greatly mitigate your risk in general, but also help you navigate through some of the regulatory issues around SAFTs. Another thing, it's important to note that a SAFT itself is generally considered a security / financial product, as we discussed earlier. But the token which the SAFT refers to may also be considered a security / financial product as well. So this just means that you need to be aware and conscious of any securities or financial services law considerations relating to the token as well as the SAFT. Now, the SAFT considerations are, relatively easily dealt with if you target, sophisticated or accredited investors. But it's also important to note that the token as well may carry with it some sort of additional financial services law considerations as well. That's actually a topic that Bobby and I discussed previously in a previous webinar. So feel free to revisit that as well. Now, a simple one that oftentimes gets overlooked is you must ensure that the investor and the token issuing entity enters into the SAFT. So in some cases, as Bobby referred to earlier, Web3 projects have a dedicated token issuing entity. This could be an entity based in the BVI, Cayman Islands, or really anywhere with favorable sort of token issuing laws. But this just means that the SAFT will be governed by the jurisdiction where the token issuing entity is established, unless otherwise agreed, but that's usually the case. So yeah, there's that. On that note, it's important to consider a group company structure that suits your Web3 project. This may include considering a global structure where you need to establish a token issuing entity, foundation, operational entities, and this can mean that you're operating in various jurisdictions because of, again, favorable laws, but also, having a easier time looking for funds as well. So just another thing to consider. Again, this is sort of more commercial and strategic standpoint as well, but it's also key to develop a fundraising strategy. Now, it's important for you to understand your fundraising options, both from a commercial and legal perspective, and determine what you need and when you need to raise funds. For example, you should raise funds via a SAFT only if you consider that the tokens itself carries with it, a significant amount of value. You may also look at issuing or raising money through issuing a SAFE or entering into a SAFE if the company that you're generating as well is capturing a significant portion of that value. And that could also be appealing to investors as well. But I think this needs to be broadly considered, and there's a range of factors that go into that, but definitely develop a fundraising strategy. And finally, I guess this is more of a commercial point, but it's essential to work on your tokenomics model and token utility. So I touched on it earlier. The SAFT and the tokens that you're creating are only valuable if the tokenomics make sense and the token has genuine utility in the ecosystem that you're trying to create. Investors are usually good, especially in this market, at identifying poor tokenomics models and poor token utility. Okay, guys, well, that concludes the formal part of this webinar, and we will move on to Q&A in a sec. So you'll also see a Web3 and financial products and services fact sheet, which you may find quite useful. You can download it by accessing the handout section in the webinar panel. So feel free to download that and give it a read. We also have an event coming up that may be of interest to some. It's on understanding your annual franchise update obligations, and that's actually being held tomorrow. So at 11 a.m. So feel free to register via the link, although knowing this audience probably won't be, funnily enough. But anyway, definitely take a look at that if you're interested. Okay, so now we'll try to answer some of your questions, and let's take a look at some of the questions that we have. Okay, so there aren't too many questions, so I'm going to take that to mean that we've done a really good job as to answer a lot of them in our presentation. There is one that I can see here come through. What is the difference between a safe note and a put option agreement? Okay, interesting. There's a pretty decent size difference, I guess. A put option agreement is essentially an agreement where the grantor, or the option holder, has the right but not the duty to require the company to acquire the shares that the option holder holds. So it's basically the company can buy the shares held by the option holder at a usually pre-agreed price within usually a defined period. A safe note is essentially an agreement where the company will issue shares to an investor for an investment amount at usually a pre-agreed price upon the occurrence of a VC round or the next round of funding. Okay, cool. We got another question popping up here. So, sorry, hopefully that answers that last question. They're a bit different, and I'm not sure what context that question sort of is asked in, but you know what, feel free to reach out to us after this webinar if you really want a in-depth answer or something more relevant to your context. All right, so here's another question. Have you seen an investor bring a claim off the back of a SAFT? Oh, interesting. Personally, I haven't seen many, right? But I think there is that opportunity at the moment. I say that, and the reason why I'm hesitating is because there is one potential matter that I've been exposed to recently where that is coming up, and the integrity of the clauses and the SAFT agreement is going to be challenged by just because the SAFT will be in a dispute context and potentially go to court. I'm personally interested in seeing how that develops and seeing how it holds up to scrutiny. Bobby, did you have any thoughts around that? Have you seen anything?
No, I haven't seen anything. Not from my end, but I wouldn't count it out just by virtue of some of the high value transactions that are occurring.
Yeah. So I think, look, and in general as well, SAFTs are usually, agreements that are thrown around in the context of, as has been the case for a number of years now, a lot of people who have made money through crypto, they're just getting thrown around the ecosystem. People who have quite a high number of, or high value of crypto holdings, and they're looking to just invest that. So it's usually a friendly type relationship, and the investors usually know what they're getting into. Unless you're operating fraudulently or you've deliberately deceived your investors, then I don't think you need to worry too much about that, because again, the investors that you're usually going and approaching should know what they're getting themselves into, and that is, it's a high risk investment. So also, just disclaimer, that is not legal advice. I'm just giving you a general opinion on that. So don't hold me to it. Okay, that wraps up that question. There's another one that has just come through. Are there any glaring reasons why you wouldn't issue your SAFT/token from an Australian entity? Interesting one. Okay, well, look, I guess I'll tackle this first, and Bobby, I'll get your thoughts on this, if you have anything to add. But I guess a big reason, and let's not sort of beat around the bush here. A big reason why SAFTs and tokens are not issued from Australian entities because of tax. There are other jurisdictions that are just more favorable from a tax perspective. If there are legitimate sort of interests in that jurisdiction where you're operating in, there's a whole bunch of tax laws that relate to this. So I wouldn't just use that as a primary reason to set up a new jurisdiction, but it's definitely a reason to consider, and it's definitely something you should sort of explore with your financial advisor, accountant, lawyer. Absolutely. But tax is a big one. I'd say that's probably the most glaring. There's also sort of financial services law considerations, and there's always a risk that the regulator in an Australian entity could sort of change their tune slightly, just to sort of crack down a little harder on the issuing of SAFTs. Potentially, another reason is to, you could run the risk, if you're not careful, you don't do enough due diligence, of issuing the SAFT to what's called a retail investor. So we touched on this earlier. A sophisticated investor is, essentially a high net worth person. There's a whole accreditation process and due diligence process that you can do to verify whether someone is considered a sophisticated investor. But there's always the chance, sometimes people don't go through the due diligence. There's a chance then you could issue it to a retail investor. A retail investor could lose money and then bring a claim against you, and then you're also sort of subject to financial regulatory law considerations as well. So that's sort of some reasons why you wouldn't issue it from Australia. But again, not beating around the bush, it's tax. I think that's one of the main reasons.
And I think flowing on from Chris's point, I think tax is the main ticket item, big ticket item here, but it is multifaceted. And like I said, like Chris said, it has the financial, the laws themselves are quite relevant, but also there's another layer, which is the government or the jurisdiction's approach in general to crypto and Web3. So obviously BVI and Caymans, they're well known to be quite friendly, and that's usually quite conducive to setting up an entity there and facilitating the token generation, the SAFT, the issuance of tokens. UAE, for example, is another one. They've recently announced some news that they're going to have a 2030 vision, and a whole lot of money is going that way as well. So that's also another favorable jurisdiction to look at.
Yeah, and actually that's a great point, Bobby. And actually, just extending further and sort of moving out of the legal considerations, thinking of things more practically. Investors, where are your investors based, and what jurisdictions are they comfortable with, basically? It's there are certain jurisdictions where investors are comfortable with the BVI or the US or the UAE, but it really depends on who your investors are, and again, what their comfort level is to invest in, or enter into an agreement in the BVI jurisdiction, UAE jurisdiction, the Australian jurisdiction. I mean, these are just sort of real world considerations. Cool. All right. There's another one that's come in. So is there a standard form of SAFT which is used most commonly in the same way as the YFC SAFT? Yes. So as I mentioned earlier, I'll tackle this first, Bobby. Again, feel free to jump in. As I mentioned earlier, the SAFT the SAFT project was the initial, the idea behind it was to create a standard form document. But like SAFTs, like the SAFT agreement that YC issued, again, depending on the jurisdiction that you operate in, lawyers get involved, and then there becomes a new market standard precedent SAFT document. And the same is happening with SAFTs, although SAFTs are sort of early in their stages. But as a standard form and as a good starting point, you can go to the SAFT project website. I think it's just saftproject.com. If I'm not mistaken. So feel free to look through that. You can download a draft version of the SAFT, but again, just with a word of caution, seek legal advice on that before you start entering into stuff, because again, there could be specific circumstances that you need to consider. But yeah, definitely look at the SAFT project website. Bobby?
Nothing more to add from me on that point, just the SAFT project and variations of that.
Yeah, awesome.
Yeah.
All right. So here's another question. Is the convertible note essentially dead now in startup funding? Okay, good. This is sort of more of a market standard question to see, where things are going. Look, I would definitely defer this to people, or to our team and the cap raising team who do this, exclusively. But I would say, from my experience, I mean, I've worked in a startup. I had my own startup for a while. I've worked with startups for most of my career. I've worked with them to this day almost exclusively. And fundraising is a big part of the startup journey, and it's definitely important. So I see a lot. In my experience, yes, I think it is. I think convertible notes, convertible notes are sometimes, debt instruments as well. And I don't think there's a need for it. I think if we're looking at the market conditions, investors who are entering into the space, the more sophisticated investors that come into the space become more comfortable with safe notes. So they're more willing to sort of enter into these types of agreements. I think there's a lot of capital in the market at the moment, a lot of venture funding that's available for startups. And again, the types of VCs and angel investors that are major players in the space are former founders in a lot of cases, or people who just have been around startups for a while, who understand that a SAFE is a perfectly good agreement to enter into in most cases to raise funding. So I would say yes, convertible notes are out. It's very uncommon, that comes across my desk at least. And I would say the same for the team in the cap raising team who do this every day. So and again, layer that with SAFT agreements, man. I mean, yeah, you're looking at a really outdated way to raise funds if you're using convertible notes. I mean, I would advise my clients against using convertible notes and just using the standard form SAFE or SAFT, or or some combination of the two as a starting point. So yeah, Bobby, any thoughts?
No thoughts from me on that one.
Beautiful. All right, guys. Well, I think that should wrap up the Q&A section. Thanks for those questions. They're really interesting. Now I'll turn it over to Bobby to sort of run you through a bit about LV, the pro membership, and how we can help.
Thanks, Chris. So LegalVision offers a unique offer. We have a unique offering, which is the pro membership, and that's when you sign up as a LegalVision member, and that gives you cost certainty as well as legal certainty at a very affordable price point, which is a monthly fee. And under that membership, you get access to some of the services which are set out on that slide, which include unlimited document drafting and reviews, unlimited legal advice consults, which I find quite valuable. For example, if you are looking to raise funds and you're looking for your next capital injection, then you can just book in a call with Chris or myself, and we can assist you with, preparing yourself and future-proofing yourself to see what you can, to best set yourself up. So, for example, looking at your investor deck, your pitch deck, and helping you clean that up so that it looks, presentable to VCs and whatnot. We also have trademark applications, which are unlimited under that. In addition, we're a full-scale commercial law firm. We've got dispute resolution, employment, HR support, but I think the legal advice consults are quite valuable, and the document drafting and reviews, particularly if you're receiving grants from Web3 players, then we can obviously have a look at those for you as well and advise you accordingly. And so the special offer which Chris mentioned today is that you can request a complimentary consultation. So by attending this webinar, thank you, you're able to receive that consultation and discuss with Chris or myself how we can assist you with your Web3 needs. And all you need to do is to leave your contact details in the survey that will appear after the webinar ends, or you can also email that email address there, reply@legalvision.com.au, and just mention that you watched this webinar. So from my end, thanks very much for attending. Chris, final thoughts, remarks?
Yeah, that's awesome. Guys, you could have been doing anything else in the world today, and you decided to spend some time with us. So for that, we thank you. We really appreciate that. Can't thank you enough. It's a beautiful day if you're in Sydney. We very much appreciate you spending some time with us over the computers, over the the virtual world. So thanks again for joining. Hey, feel free to drop us a line today. I mean, I've got some free time this afternoon if you really want to speak. So definitely would be happy to chat further and help you on this journey. But again, thanks again, and see you around.
Thanks, guys.